I happen to be in Northern California, and this Silicon Valley Bank closure has rattled a lot of people in the world, but especially in the Bay Area. So many of our clients are depositors at Silicon Valley Bank, or were, or are, and maybe we'll talk about how that works, as well as some other banks that are under strain. But hi, this is Jim Cunningham. I've got Christina Lindsay Orta and Phil Blancato here at the very beginning. We're going to talk about the collapse of Silicon Valley Bank and equally important, how to invest in the slowing economy. So what we're going to cover here is the fact that 2022 was worse than 1929 when it came to a 60-40 stock portfolio return, and this directly impacted the Silicon Valley Bank collapse. We're going to cover FDIC Insurance, what that means, a 250 coverage. We're going to $250,000 coverage. And then Christina, we'll let Phil go. And then we're going to cover some other type of essentially cash management assets, fixed income investments, real estate funds, private equity, and structured notes. We'll go through those. I'm Jim Cunningham. I've been an attorney for a really long time. Obviously, you can see 25 years is long enough. And I'm a certified specialist in estate planning, trust, and probate law. We have a team of attorneys in Northern and Southern California, and we've also got Christina here, who's joining me with Phil Blancato, and we have offices in Northern and Southern California. Before we get started, this is a disclaimer. Anything we say here is information only. Don't run out and do a bunch of stuff based on this. So we're talking, and we're seeking to understand what's going on in the world. It seems a little crazy. And then any guarantees are backed by the claims of the issuer. Yet another disclosure. So Silicon Valley Bank failure. Let's turn it over to Phil. Phil, you're a New York City guy. You're a finance guy. You're a whiz. You're on TV a lot. You understand this stuff. I've known you for many, many years. I have great respect for you, your depth of knowledge. Tell us from, because maybe we're too close to it, right? I'm in the Bay Area. It's like, tell us what's really going on.
So it's actually somewhat simple. When you think about the last few years, this tremendous influx of money that was poured into the U.S. economy by the federal government creates unusual moments. For example, runaway inflation was created by so much money coming in, call that demand, and so little supply, not enough stuff to buy. So we always have this runaway inflation. Something similar here. What happened with Silicon Valley Bank is that in the span of 2 years' time, from the end of 2019 to really the end of 2022, in about 24, 26 months time, they raised $189 billion. And that money was as a result of the federal government pushing money into the system. Think about the PPP loans and money's handed out to folks. That money came into the bank in the form of deposits. When the money was sitting in deposit accounts, whether it was a company, a startup, a tech startup, or just some local person who used them as a creditor bank, you like your local bank, that money sat there in cash. So that kind of influx, usually what banks do is they take money in from, let's say you go to a bank and you put $100,000 into a bank. And then I go to that same bank and I want to borrow $100,000. Their job to make money is take your money in, give you a little bit of interest, lend it to me, charge me interest. And the spread between those two interest rates is how they make money. That's all banks do. And they're usually backed by rules and regulations and so on. What this bank did was they had this $200 billion or so of money come in, and they had no demand. So all these folks came in and dropped off this cash, and no one wanted to borrow money. Why did no one want to borrow money? Because the federal government was lending out money out hand over fist, so there was no demand for loans. One of the problems with raising interest rates, no one's borrowing money, so you can raise interest rates pretty much all you want. It hasn't slowed down inflation all that much. So what this bank did was said, we have all this money. What could we do with it to make more money? So what the bank decided to do was take unnecessary risk with other people's money. So banks traditionally keep 80% of their deposits in short-term lending vehicles. Think about if you went to a bank and you bought a CD. What are CDs usually? 6 months, a year, 2 years, something like that. That's what banks do with the vast preponderance of their money. And what the federal government does is says, okay, for all the money you have in your bank, we're going to pay you interest on that money. That's what, when we raise interest rates, it's the federal government paying interest to those folks who have the cash, or if another bank might pay them interest. They just how the system works. So every time you raise interest rates, banks actually make more money on cash deposits. But this bank had all this money come in at a time when interest rates were very low. Remember, 2 years ago, interest rates were nowhere. So what did the bank decide to do? They said, well, we're not making any money in short-term reserves. We don't like keeping 80% in non-yielding investments. We're a for-profit company, so we're going to go out and we're going to invest this money into bonds. Now, they could have bought 1 year or 2 year bonds. Great. Short-term bonds mature. You always have cash coming in. Someone wants to go and take money out. They'd have cash available. But they got cute. They went out and bought 10-year U.S. Treasury bonds. And I'm going to teach you all something called duration. Duration is really important. Duration means the amount of time it takes to get paid your money back. For example, if I bought a 6-month CD, my duration of ownership is 6 months. If I buy a 10-year Treasury bond, my duration is 10 years. But duration matters because as interest rates go up and down, it changes the price of a bond. So they bought 10-year bonds or a 10-year duration at roughly 1.5% interest rate. As interest rates over the last year have skyrocketed, going from 0.25 to 4.5, every time interest rates go higher because the Federal Reserve is hiking rates to try and slow down inflation, well, guess what happens? Think of it this way. If you wanted to buy a bond today and you went out and said, I'm going to buy a 10-year U.S. Treasury bond today, you'd get a whopping 3.5%. If you bought it last year, you would have got 1.5%. So which bond would you rather own? Of course, you'd want to own the one that's earning 3.5%. To make that bond from a year ago equal to the one of today, it's got to go down in price. So simply put, as interest rates go higher, prices of existing bonds go lower. So the $200 billion they had in Treasury bonds got marked to market down to $180 billion. They were $21 billion short or not short. They had losses of treasuries of $21 billion. The problem was they became somewhat insolvent because if they went to sell those bonds, then they would realize the loss. So all of a sudden it got out that this bank didn't have a lot of liquidity, not a lot of cash on hand. The investments that they made were underperforming and the bank needed an infusion of capital. The regulators looked at it and they looked at from a capital ratio, how much cash they're supposed to have based on deposits. They didn't have enough. So then they had to go to the market and they had to find Goldman Sachs or someone like that to raise them money based on the total value of their bank. And when it came out that they had a $21 billion loss on their balance sheet, the bank's not worth $21 billion. So basically what they did was you're insolvent, you collapse. Now, truth of the matter is there's 3 things that led to this. One, the bank took on unnecessary risk. They should have never done this. They should do what all banks do, which is they keep their money in very short-term investments, 1 to 2 years of length that can be sold at any time for no real loss. They should have did that. They did not. They took unnecessary risk. That's one. Number 2, this move by the federal government to raise interest rates at the fastest rate really in history, other than a brief time in 1980, creates problems. And the reason why they're doing this is because we had too much cash in the system from overstimulating it after the pandemic. And now you have a scenario where because they're raising rates so quickly, companies that make bets are getting hurt. So this is an idiosyncratic event. This is a singular moment. It's not a banking crisis. What you don't see today is massive losses at the consumer level. In fact, consumer defaults are tiny today. There's a little bit in car loans, a little bit in credit card debt, nothing serious. There's nothing in the housing market. In fact, the housing market just today came out with spectacular numbers, continue to be very strong. This is not corporate debt. These are not banks that have losses. This was an investment decision gone bad. So that was one mistake caused by the Federal Reserve hiking rates so quickly to fix a problem that they created. That's the second mistake. And the third one, something quite interesting. And this hasn't been talked a lot, but I think it's very important. In 2008, and once again now, there's a rule in the banking system that was created after for those who are as old as I am, the the S&L crisis, savings and loan crisis of 1980. Remember Ross Perot, way back when? The savings and loan event way back when created a need to market assets that banks hold. So in 2008, all those homes that banks held had to be marked to market. When they were marked down 40, 50, 60%, all those banks went default, i.e. Bear Stearns. In this case, the bonds on that balance sheet of this bank had to be marked to market. Here's the irony. If the bonds were just left alone, they would have matured at par 10 years from now. The bank would have had no losses whatsoever, and everything would have been fine. In fact, the federal government could have very easily did what they're doing for Credit Suisse, which is swap those bonds that they held for new bonds, move the bonds to the federal government. The federal government would not have lost any money, wouldn't have had to give them any money, just swap out the long bonds for short bonds, and the bank would have never failed. They would have corrected a bad investment decision. But in the end, everybody, it's really important. This is not a firm-wide banking crisis. We don't have that today. Banks are in the safest position that they've been maybe ever. The biggest banks, especially, have lots of deposits. Why do they have deposits? Like I said before, all that cash from the federal government. The changes made post-2008 for the housing mortgage market have created some of the best housing market maybe ever as well. You have lots of good high credit in the housing market. It's not an issue. If you look at Signature Bank or First Republic, Signature Bank was a crypto bank. You saw what's happened to the crypto market. That's a separate event. Credit Suisse was not a good company, hasn't been a good company for a long time. Credit Suisse, very similar situation to this, where they made an interest rate bet. It's a long story, but Europe had negative savings rates for a long time, negative interest rates, which is a whole other story, which led to this problem for them. So these are events that are happening worldwide to a degree because of the move higher in interest rates. So companies that made bad investment decisions or just weren't good companies are struggling, but it's not systemic. This is not Bear Stearns, Lehman, JP Morgan moment. And that's the most important takeaway from this.
And I would argue, Phil, that this is a credit issue, not a liquidity issue. When you really isolate this, that Silicon Valley Bank was lending to venture capitalists that were lending to tech firms that could not stomach a higher interest rate market, that needed a lot of access to liquidity in a higher interest rate market, and had to cash out those deposits. And so this was more of a credit problem of who they were lending to versus the bank having, a systemic problem across multiple banks. There's not a liquidity issue across the banking system. This was an isolated credit lending issue with Silicon Valley Bank, and then what they did with their capital on hand.
So let's tie that back. Great point, Christina. What Christina's point is now, these companies that they loaned money to in a rising rate environment, a slowing economy, needed money. They needed money to make payroll. So they went to the bank to get money. And because they were not really strong companies that were making lots of revenue, they needed to borrow money from the bank or take out some of their deposits from the bank to survive. So Christina's spot on. Lending money to startup companies that don't generate any revenue, suddenly in a cash crunch scenario where, the economy's not doing well, you see what's happening with Meta laying off thousands of people and Google and so on. So at a time when these tech companies are struggling, well, they went to get some deposits from their bank, and guess what? The deposits weren't available. And that's what caused this. So by lending the startups who didn't have real revenue, it created a problem. But let me give you an example why I don't think this is systemic. I know we have all these talking heads out there, including me, as to why the banks are great. The banks are great. You're having to take my word for it. I want to give you an example of what a government stress test looks like. So in 2022, the federal government the Federal Reserve had a stress test for the nation's banks. And here's how the test works. The tests go out and they create a scenario. The scenario, which is unemployment would have to rises to 10%. It's not there today. We're making this up. So an environment where unemployment rises to 10%, GDP declines in tandem and falls into a recession. Commercial real estate drops by 40%. Home prices drop by 28.5%. Stock prices drop by 55%. Are you ready for this? All the banks in the test passed from a capital ratio. So in other words, projected losses would have been something around 400 billion to 100 billion to 400 billion. Cash reserves today are in excess of 600 billion. So in other words, this is not a problem. When in a scenario that was dire, as I just laid out to you, you can imagine stock market down 55, houses down 28, all the banks still passed. Why? Because they are required, post the 2008 issue, the requirement to keep excess cash on hand is what saves these banks. When you look at the amount of cash deposits they have, it's quite high. And in fact, banks right now traditionally are a great bet. Why? Because they are earning 4.5% on cash reserves, and they're paying you in your savings account probably a whole heck of a lot less. So you're probably getting, without even realizing, your cash at your local bank is probably earning you half of 1% or 1%. The spread between the two is how they make money. So really, banks not only are they in great shape, they're a pretty good investment right now. And
Phil,
that is why this whole thing is unusual and different.
Phil, I have a question. It's really a kind of a lawyer's point of view. It's a foundational question, which kind of goes to how do you know all this stuff? And not you in particular, but how do you find out how a bank invests their assets? I mean, was this publicly available information 2 weeks ago? Were there any red flags? Were there any, is there board of director liability? Is there liability on the part of the bank executives, the C-suite, if you will? How do you know if a bank is going down the wrong direction is where I'm going.
That's the problem. You just use the word that you can't use. It's a provocative question. You can look at, by the way, the bank has to issue not only an annual audit report, which you have access to as an investor. If it's a publicly traded firm, they're 10Q and 10K. But you used to use the word wrong direction. who are you to say it's the wrong direction? Who am I to say it's the wrong direction? Because their bet on interest rates is not illegal. They didn't do anything illegal. They made a foolish bet they shouldn't do. There is not a requirement today for banks to keep their money short term, because this is the normal thing, because you're getting money paid to you by the federal government in the form of interest rate. This bank did something highly unusual. And from a fiduciary standpoint, that's a different dialogue. From a lawyer standpoint, you could argue, depending on what that bank's charter is and how the board is set up and what fiduciary standards they follow, there's probably a fiduciary breach in there where the board is going to be liable for not having. Long story, this bank did not have a chief risk officer installed for 10 months. There's the liability, not that they went long. The long decision was some knucklehead made an investment decision that I bet probably went unnoticed. I'm going to bet the bulk of the firm that we have our money invested didn't really care about it. Rates were low and it wasn't really thought through, because banks are not investment firms. That's not what they do for a living. So some knucklehead in their treasury department went out and bought a whole bunch of bonds thinking, oh, I'm meeting our credit quality requirement by buying treasuries, but no one probably even noticed they went out 10 years. And you know what reward they got? A 10-year treasury at the time versus a 1-year treasury, the difference was about 1%. So for a whopping 1%, they went out there and took on a ton of interest rate risk, which is what this is. But there's probably a breach in the company's charter. And I would say ultimately who's going to be responsible? And they've already been fired. The CEO, the chief investment officer, and the board is going to have an issue here at some point.
Well, and in this particular case, the CEO had a seat on the Federal Reserve Board for the San Francisco Fed. So it was very much the fox watching the hen house. And the amount of stuff that happened in this particular isolated bank, there's going to be fallout. But this is really isolated to this bank made a lot of stupid decisions, not having a chief risk officer, having a CEO on the Fed Reserve Bank, selling their stock positions before the bank failure. I mean, there's a lot of highlighted issues in this particular bank. And then also having a balance sheet that was hold to maturity assets that then started getting marked to market in a rising interest rate market. You contrast that with JP Morgan and Jamie Dimon. He took how many trillions of dollars out of their hold to maturity bond portfolio and started repositioning them in short term and taking a little bit of a loss so that they had liquidity.
That's what you're supposed to do when you have a big bank. And by the way, some of it's kind of goofy. If you look at Signature, which we didn't get into, it's a crypto bank. Barney Frank is on the board of Signature. One of the Lehman chief risk officer is on the bank of Signature. So some of this stuff is goofy. I mean, you kind of got to scratch your head. Don't these people figure this stuff out? But more to the point, when you think about this scenario, no one lost any money. The only people who lost money was the bank itself by its investments. So people who were investors in that bank lost money, and they could probably sue for mismanagement of the bank. But thankfully, all the depositors were made whole. By the way, the FDIC fund, and I'll back one up. I'm not a political person. I don't care left and right. It's meaningless to me. My job is to help you all make money. But I would argue that the administration did everything. The Federal Reserve Administration Treasury Secretary did what they were supposed to do. Use the money that's paid into the FDIC fund by bank fees. Use that money to backstop depositors. But in this case, there was nothing to backstop anyway, because there's no losses. There's no one's going to lose money at this bank at the depositor level, but it's there if needed. That's what FDIC insurance is for. And then the federal government saying, we're going to back up all creditor. Everyone who had money in the bank will back them up. And that's, I think, a smart move, because it was an investment decision that led to this. So I think the actions by the federal government helped to take away some of the anxiety in the system. And I think it was smart with what they did here, because it's not as if we'd have a lot more banks doing this. You would have to make an assumption that every single small regional bank in the country, and this wasn't a regional bank, this is the 16th largest bank, but all these other mid-sized banks that do this were dumb enough to make the same decision. And I just don't think that's the case.
And I know that I don't want to keep you for too long, Phil, because I know you did me a huge favor. I called you literally 2 days ago and asked, could you be available for our webinar today, just due to the crisis that everyone's trying to navigate, especially in California, because there are a lot more clients here that do have deposits and corporate deposits with Silicon Valley Bank and First Republic for that matter. So I don't want to take more than another 5 minutes of your time, and then we can get on to some other parts of the presentation where we'll talk about cash alternatives, where to seek yield in a slowing economy. So we'll get into that in a few minutes. But while we've got Phil for 5 more minutes. I want to make sure we take some questions, that we don't see this being a contagion at this particular time.
Yeah, we have a question. It says, although Silicon Valley Bank didn't do anything illegal and presumably regulators exist to detect such activities, presumably, was kind of my question, should regulators have been more informative to either Congress or its proxy entity or to the public? Which to me is like, whenever something like this happens, then it's like, politics is not leading the parade. It's like the guy at the end of the parade scooping up the elephant dung, right? I think what's going to happen, there's like this catastrophe, right? And then the politicians come in and they go, yeah, we need rules on this. So would you anticipate any further regulation on banks or not? Or is this just a complete one-off?
Especially for mid-sized banks that are dependent on cash reserves. I'm sure they're going to put in a requirement now, though Dodd-Frank will put a new rule in that says banks can't hold more than 2 years or 3 years of maturity in bonds. But you want to be careful about one thing. Banks are built in the United States, at least, to take on some risk. Because when banks take on risks, that means they fund tech startups, they fund new ideas. And if you make banks just purely utilities that are so regulated that they can't take any balance sheet risk, well, then we don't grow. So it's a fair balance that we got to be careful. This is the genesis of capitalism, that we're willing to take risk. Now, should they have taken this kind of risk with other people's money to this degree? No. So you want some controls in place, but you don't want to completely control or govern the banks to a point where they can't do that. For example, if you look at Japan put in real draconian rules on their banks 20 years ago, and their banks are zombies. They basically are just utilities for the federal government. They don't grow there. So it's a fine line. So yes, you learn from these mistakes. The regulators knew about this back in January, but the regulators had to be careful too. That their regulators can't say, hey, you made an interest rate bet we don't agree with. They don't know. No one's got a crystal ball, not me or anyone else. So probably some prudence around duration, I can imagine, for cash would be an outcome of this. I wouldn't expect significant rulemaking because it would be inappropriate, in my opinion, at least.
So Phil, I have one more question. Whenever there's a loss, the next question is, okay, well, who's going to pay for this? First of all, is there a loss? And before we started, you mentioned that in the last 3 days, their bond portfolios would have gone up because interest rates went down. So it would have, taken away a lot of that loss. But number one, is there a loss? And secondly, who ends up paying this? Do consumers pay it through fees and higher interest rates? Is this going to be in a government bailout? What are you seeing?
It's not a government bailout. The people who are going to lose money are people who made investments in a signature bank, and those folks are going to, unfortunately, lose whether you invested in the stock or you invested in signature bank. Silicon Valley Bank stock or bonds. Those investors who put money into that company are going to lose, because now that's all been marked down to zero. Those are the folks who lose. Those are the folks who could sue the original bank from a standpoint. I'm sure there'll be some class action as to when the pieces get broken off, they'll get some of their money back, depending whether they were in the bonds or in the stock. So the federal government doesn't have to bail anybody out. They're not going to bail out the investors. There's no real loss here in that sense. I don't. It's just a byproduct of markets. You make investments in a company, it didn't work out.
Are there any financial sector investment opportunities in a changed way as a result of the collapse of Silicon Valley Bank? Are you seeing? Is it like now's a good time to buy bank stocks? Right?
Yeah, I'd buy mid-cap banks. I would absolutely. I think mid-cap banks in a expansionary economy are one of the best places to be. And you're getting them really inexpensive. You probably have lots of volatility there. We have an allocation to them, get nice yields from them. And some of these banks have been unfairly punished they've done other, some are real quality banks. And here's the thesis on that. Most of the folks who use mid-cap banks or mid-sized regional banks are folks who are gainfully employed right now, starting new businesses. The U.S. economy is still chugging along, not gangbusters, but doing fine. So you don't have stress in the economy right now. And that's where I think you do make a bet, especially when you have a dislocation because of some lunacy around a company that did something not great.
So I've got 2 more last comments and we'll let you go, Phil. One of my clients typed in a comment here and said, being that she's with a startup in Silicon Valley and her company was with, Silicon Valley Bank. Now that they're moving their assets to more smaller banks, do you see the smaller banks suffer from massive withdrawals due to the Silicon Valley Bank crisis?
Yeah, that's one of the downsides of this. I think the big banks are going to benefit. You're seeing JP Morgan taking billions of dollars in deposits because folks are running for cover here. And that's unfortunate because now you have to pay higher fees to JP Morgan. You don't get that kind of hand in glove service that you would get at a small local bank. Now, these things tend to fix themselves over time. When something closes down, someone else will open up once the dust settles here. But these small banks serve a very important purpose, and that's why I don't want to see them get overregulated. We need to have them. They are listen, small businesses, 52% of the nation's workforce. Is the tech sector is the future of the world, and we own it. And without it, we won't survive. And we won't be the pole position U.S., the greatest economy in the world. It's what makes us such a unique country. And so this kind of stuff matters. You got to be really careful about not being supportive of these institutions that help make that come to life.
And
I would really be disappointed if that happens.
I think there was a good comment this morning from at the Estate Planning Council, one of the executives from Montecito Bank and Trust said that they actually do a stress test every single month, even though they're not required to as a small bank. They do, they price their assets to market every single month. And so I think that those are some fair questions to ask your regional banks too,
Yeah.
of what their stress tests look like. But
that's a great idea.
All right, before we let you go, there's
Very
one
important.
last question, and this is the Credit Suisse thing you mentioned. Jeff has a question. If they would have opened the window, quote, at the Fed that backs U.S. bonds at face value before the failure, would Silicon Valley Bank have still failed? If not, why didn't the U.S. government just do that instead? Is that something you think they considered, or it's not lawful to do that? Is there
I was
some
very
regulatory-
surprised they didn't do that.
Yeah.
I was very surprised. All they had to do was swap the bonds like they're doing for Credit Suisse. Swiss National Bank is going to come in. They're backed by the government there. I guess they didn't want the perception of a U.S. bailout of a bank again. I'm going to guess some of that was perception. You heard Janet Yellen come out and say, "We're not bailing them out. We're just making sure everything works out fine." And backing up the depositors. They didn't want to look like they were saving the investors. So I think politics played into this. The easiest thing to do, open up the window at the Federal Reserve, let them exchange the bonds, or just give them the capital, by the way. They only needed a couple $1 billion in capital and say that you're now a debtor of the United States government. We see you've got guaranteed assets on your books. You had the money in U.S. treasuries. Heck, if you really wanted to, all you had to do was exchange the treasuries and give them back to face value of those bonds and hold them on the balance sheet of the federal government. It's nothing. It's pennies to the federal government. They could have really done something smarter here, in my opinion, but I don't run the government, and I guess they didn't want to deal with the politics of it, so they took the easy way out.
Are there any other banks on the horizon that are a potential problem that there's a question about First Republic is where I'm going with that.
First Republic's a good bank. What First Republic is an asset manager.
Yeah.
So First Republic has lots of bonds that are underwater. By the way, those bonds are owned by some investor. So what happened with them is kind of similar. If they needed liquidity, they had trouble generating it. Well, today, 7 banks got together and loaned them money at an interest rate to give them liquidity. That's what happens in the banking system. This is normal course. What happened for First Republic is not unusual. Banks loan money to each other all the time. And because the Federal Reserve is hiking interest rates, it's creating stress. But to your answer question, Jim, we just don't know. Right. We don't know how many banks out there made some of these foolhardy moves. First Republic's not a bad firm. And First Republic just needed capital to get through this liquidity crunch that they're in. They have lots of very wealthy investors, lots of institutional money. That's not a bad shot. In fact, I'm surprised some big firm like a Schwab or JP Morgan or Goldman didn't come in and buy them. It's a good firm, good bank, good assets. But what's on the horizon? I think we'll hear more of this. I don't think this is a singular event. It's not a systemic event. It's not bank A's, they're not contagion. They're not connected. But you're going to find other banks that some knucklehead made a decision and owns 2 bonds that were too long and can't generate liquidity. But the Federal Reserve opened up the Fed window. As long as they open up the window so banks can borrow against the assets, and I bet they're going to do what Europe is doing. It sounds like Europe's going to set up an exchange program where you'll exchange the bonds back. If you do that, it should be fine.
Great. Well, Phil,
thank you.
Thank you so much. And Phil, hey, you're doing a great job with my 401k. So I want to thank you. Lori and I thank you a lot. Ladenburg Thalman, that's what you run. That's where it is. So awesome job.
Thank you,
Take
Phil.
care, everybody.
Appreciate it.
My pleasure. Bye-bye.
Well, I know we had some additional bank questions, but I think we got most of these.
We do. And I think, yeah, this will be answered as we kind of go through some of these materials. But wow, that was fantastic, wasn't it? Gosh, I could listen to Phil all day. He's fantastic. So
yeah, I really appreciate him making himself available at the last minute just to kind of give everyone some peace of mind. Phil also does a podcast every Monday, the Weekly Market Impact. So if anyone wants to get more information from Phil, he does make a lot of information available, but we'll kind of move on here and hopefully be able to get to some additional content.
Yeah, let me tee this up, Christina, because this is when, and you and I talk to clients a lot, and this question comes up. It's the I don't want to put all my eggs in one basket. Look what happened to Silicon Valley Bank. I need to make sure that I go to all these different banks and I put $250,000 in each bank to get my maximum FDIC insurance. I think there are a lot of misconceptions about what FDIC insurance frankly is, what it covers. And if you can just walk through that with us, I think that would be, and if you're listening to this and you think you know what FDIC insurance is, I really want you to empty your brain, because it's not exactly what many people think it is. Let me put it that way.
Yeah, and I actually had to even kind of revisit this with some of the compliance officers from banking institutions. And so in the banking world, it's FDIC insurance. In the credit union world, it's NCUA. Works very similarly. So you want to make sure that if you're in a credit union, they've got the NCUA coverage, but it is $250,000 per depositor per insured bank for each ownership category. What I mean by that is if I have an individual account and I have a joint account, I'm insured for $250,000 for my individual account. If I have a joint account with my husband and we've got $500,000 in there, we're insured for the $500,000 for deposits of cash. And then if I have a joint account then with my daughter, I can only use my $250,000 across one joint registration. So if I had 150 with my husband and 100 with my daughter, I'm insured. But if I had 250 with each, I'm only insured for 250 of the joint registrations.
Meaning it goes by account registration. So if you're a joint account owner with 4 different people, you get 250 on those 4 accounts. Mm-hmm. But if you have it in your living trust, you get another 250. Mm-hmm. So, and then if you and your husband have an account, you get 5. And then you might have an irrevocable trust, you get another 250. And if it's in an IRA, is an IRA on here or not?
An IRA is another registration.
Yeah.
So this is per depositor, per bank, depending on account title. So there is a lot of confusion there. But I think that the point being is we can do a better job of getting people aggregated FDIC insurance. If having FDIC insurance, if there is a corporation or an individual that needs to have that much cash on hand, we can do so with other forms of cash management. We could even do so in one advisory account and get FDIC insurance up to 100 million.
100 million in an advisory account, not a bank account.
Because we can aggregate pools of banks in one account so that you're not forced as an individual to go open an account at this bank and an account at this bank and an account at this bank, because all that does is complicate things for an estate.
Yeah, well, and also about business owners, like, a lot of the people at Silicon Valley Bank, I think the average deposit was like 4.1 million, because this is literally like operating capital for companies. If I'm running a company and my payroll is $1 million a month, I might have to have operating cap, I don't know, like 5 million or 2 million, it depends on what I'm doing. Where do I put that money? Do I put it at a bank? What are we're going to talk about that, right? Like if you're a business owner, what you do. So SIPC insurance.
SIPC insurance, this is for securities. So there is securities, if there was like a fraudulent security issue, SIPC insurance is different for securities than cash. SIPC, if there is cash inside of a brokerage or an advisory account, SIPC insurance will insure the cash up to $500,000, but they'll insure securities. Typically, depending on the carrier, the custodian, they're going to secure securities up to about 50 million typically.
Yeah. And so that's like if you go to I'll just say a stockbroker and you say, I want 100 shares of Apple, and you give the stockbroker money and they give you a share of Apple and it's fake, right? Like it's just not real. Is that what you're saying? Right. Okay. All right. Probably doesn't happen that much. Okay. Cash management for high net worth individuals. Let's talk about this.
Yeah, so cash management, what we can do, certainly there are a lot of different ways to do cash management. Now, if you're a corporation and you really need to assess your liquidity, how much do you need in the next, 30 days, 60 days, 90 days, there are such things as even just doing custom cash management where we can do, 60-day treasuries, 90-day treasuries, short duration, as Phil said, where we're not taking interest rate bets. And able to get better yield than just cash. Although yields are currently high on a lot of cash management, we offer for any of our clients that keep over $1 million with us, we do make available, there's a newer program that's been around for a while, but we now have access to it, where they'll aggregate and insure up to 100 million in one account. And it's currently yielding over 4%, FDIC insured up to 100 million. So we can do that. And we only make that available to our existing clients. But the other thing that we can do is very custom when we're dealing with 10 million or more, and we need to have cash management for a corporation or a business owner. We can do custom cash management with Phil. He's an institutional partner of ours. So I know one of the questions on the question Q&A was, can we have Phil's contact information? Sorry, you can't. He works with us. He's one of our institutional partners, but he is a close personal friend. And he and I will coordinate on 10 million and above accounts and do custom cash management, where we'll figure out what the corporation's cash needs are for a year, 18 months, 60 days. And we'll do different types of securities that are principal protected.
So last year was worse than 1929 for the 60-40 portfolio. That's if you had 60% in equities, which is stocks, and 40% in bonds, which, you know, treasury bills, all that. And Silicon Valley Bank is an example of, you know, what it's one of the effects of 2022. Interest rates went up, the value of that 10-year bond went down, and there was a mismatch between demand on deposits and their holdings of assets. And it, you know, it caused the collapse, as we saw, of Silicon Valley Bank, and that it hopefully it looks like it's isolated to only those banks that made bad bets. There's not a systemic issue.
Correct.
That's actually very reassuring, because I've been worried about that. I mean, I know we're all worried about it, right? Because
I think that it's important to note, you know, I think that, you know, there's been also some comments or questions in the Q&A, you know, bonds, you know, being a bad place to be. Well, it goes back to what Phil was saying, is that bonds are a seesaw. So as interest rates go up, the value of the bonds go down. As interest rates go down, the value of the bonds go up. So last year, when you're in this rapidly rising rate environment, worst year on record for the bond market and, you know, in history, double digit down, you know, the Barclays Ag Bond Index was down double digits. So that's just unheard of. You can see this negative 13% for 2022. That's just unheard of. Now that we're kind of nearing the end of the, you know, who knows when the Fed's done, but what we do know is we're not in the beginning stages of the rate hike cycle. We're probably nearing the end of the rate hike cycle, whether we go up another 25, 50, 75, or another percent from here, we're nearing the end. And so a lot of this is priced into the market now, and now you can own a bond. You can even own a municipal bond and get 4%, which we're going to talk about that. But you can get a good interest rate. And if interest rates, we know, okay, let's just say we buy here and they go up a little bit more. Okay, the value of our bond might go down just a little bit, but we're kind of hitting that cusp of eventually, I don't think anytime soon, and no one has a crystal ball, eventually interest rates will come back down. And when that does happen, our higher coupon interest rates are going to make our value of our bonds worth more than what new bonds will be issued. So bonds are a good place to be now. Someone like SVB making a bet on interest rates staying low for a long time in early last year, not a great place to be in bonds then, but now it's a great time to be in bonds.
So, I mean, we can see the Fed fund, these are the rate hikes. This is the amount it was hiked in these time periods. So when you're saying that we're close to the peak of the hike, this is based on history, right? And you have to go back to 2006 where they raised it. It looks like 4.25. So
yeah, and if I were to look at, you know, no one has a crystal ball. You know, Chapman University, I follow their economic division quite closely because they're pretty superior as far as their economic division outlook, their forecasts. You know, they project that we're going to peak out at 5%. Whether that happens or not, it's probably in line with where we'll peak out on the Fed funds rate.
So what do we do now?
Great question. So, you know, no one has a crystal ball. It's very rare to have 2 consecutive negative years on the S&P 500. I think if we have a recession, you know, everyone's kind of, the question is, will we have a recession? Well, we know we're a late cycle economy. We know we're in a slower growth economy. We don't think that this is going to be some long, drawn out, wide and deep recession. We don't have a fundamental lending crisis. We don't have huge defaults. We don't have runaway unemployment. We do have inflation, which is the biggest problem, but we've already started to see some wage growth compression. But because the employment market is still so strong, our consumer spending is, consumers are still spending. And the reason why they're stomaching this inflation is because they had cash on hand. They saved money during the pandemic. So we're not expecting this to be some wide and deep recession if we have a recession. If we have a recession, it's probably the most predicted recession that's ever existed. So how much of it's priced in the market, we don't know. What we're hearing from most people is that we're going to continue to see volatility. I think a good example is last year from June to December. I think the S&P 500 fell 2%, but along the way had 9% swings along the way. And so someone best coined it as we're violently going nowhere in the market. I think that will continue to be the case for some period of time. So I'm trying to set expectations with investors that I do think that it might take another year before we really start to enter another bull market. I think we need to be patient that volatility is not going away. Inflation's not going away. So how do we invest with, I still think that if you're a long-term investor, equities make a lot of sense. Dividends are great. We're finally getting paid good yields. So we don't want to be overly defensive. We don't want to make any particular bet, but where can you go for safe money? There are a lot of options right now. There are a lot of options. So if we take a look at different sources of yield, this is kind of where we're looking at dividend yield on utilities. You're getting over 2% dividends on high quality utility stocks. US public REITs are paying, around 4%. There are some interval funds, which we'll talk about, and private REITs that are paying closer to 6%. You've got blue chip dividend equities, great place to be. You've got treasury bonds. Now, treasury bonds might be a decent place to be. The caveat that I would give people is they were highly volatile, as we saw. That's what drove some of the Silicon Valley Bank failure, was they made too much of a bet in treasury bonds, which did lose value. And treasury bonds are still taxable. And if you're in California, if you look right in that next column, municipal bonds, you can get 4%, state tax-free, federally tax-free. So that, if you can get the same yield and not pay taxes, why would you want to give up half of your yield on a treasury bond in taxes? So there's a great place to be in bonds now.
And remember, a government bond is only as strong as the issuer's ability to tax. And as a California resident, I can tell you, California is very effective at taxing its citizens.
They've even given us a tax break just for our recent rain, Right. We don't have to file returns until October.
Very effective.
But the current yield curve.
So what is a yield curve? What are we looking at here? What is this?
Yeah, so this is just what as Phil had mentioned, duration. You've got, a 6-month CD is a 6-month duration. A 10-year bond is a 10-year duration. And so what we're seeing is that the longer you go out, you don't get a whole lot of additional yield in this market. So why get a 10-year bond when you can have liquidity to your money sooner and get paid a similar yield? So this is just kind of giving us an idea of what you can get. I think the last time that you could get 5% on a 1-year CD was in 2005. So, yes, you can do a 1-year CD, but that does mean you've got illiquidity for that 1-year period of time, where there are some other options that are yielding over 4% that have daily liquidity. So I think that it's important to understand what your needs are when it comes to liquidity, what your taxation is. Again, CDs are taxable and illiquid, have penalties for liquidating early. Same thing with treasuries. But there are other things such as fixed indexed annuities that have tax deferral, that have principal guarantee. You have principal protected notes with different bank issuers. So there are banks that will issue principal protection on notes. And so those are another sector to gain additional yield.
What sort of terms are you seeing? And again, when we say annuity, a lot of people go, oh, I don't like annuities, or I love annuities. You need to just empty that from your mind, because I think what Christina, you're talking about is you might do a fixed indexed annuity for 2 years. and
Yeah.
you're going to defer the tax bill for 2 years.
You could do a 1 year, you could do a
Right.
2 year, you could do a 6 year. So,
Right.
and the
It's
thing
like
is,
it's like a CD that's deferring the tax bill for
deferring the
right.
taxes, but there are some no fee annuities out there these days that allow you to participate in the market. So I think that we're going to have a slide that just kind of highlights the we'll talk about the annuity in just a moment, but I think it's important to address treasury volatility, because I think we got a lot of calls in the last year of, I just want to buy a 2-year treasury, I want to buy a 1-year treasury. Well, those treasuries still lost 5% in the principal value. So if you had to sell that because you panicked that your account value lost money, if you had to sell that in that 2-year window, then you took a loss. And you have the illiquidity during that period of time, and the interest is taxable. So if you can get 4% again on a treasury bond, and keep 2% of it in California if you're in the highest tax bracket, and get a municipal bond paying 4% and keep all of it, which one would you rather have? And a lot of the municipal bonds that we do are insured. They're water districts, utility districts. I mean, the LAX airport is doing a ton of municipal bonds right now because they're preparing for the Olympics. So when you've got an insured investment grade municipal bond, again, it's insured. Why would you not clip a 4 to a 5% tax-free coupon if you can do that? And typically the duration is longer, so you can keep that interest rate coupon for a longer period of time.
I mean, it's a great deal. I mean, to get 4% tax-free, you're not paying state and local tax or federal tax. That's fantastic, right? I mean,
exactly.
Great.
So here's where we can talk about moderate protection. When I talk about short-term income ETFs, now an ETF is a daily liquid, trades like a stock. It's an exchange traded fund. You can get in and out of it, no penalty. And there are short-term income ETFs. There are some that are managed by big banks. JP Morgan has one. You've got multiple different firms that have them, that you can earn a good interest rate, unlike, not too dissimilar right now from a 1-year CD, and not have to lock up your liquidity. And what they're doing within that fund is they're purchasing different laddered treasuries and securities to generate that yield without having a whole lot of price fluctuation. So is it guaranteed? No. So can I say that it's 100% principal protected? No, but it's got a pretty good level of protection with a pretty good yield and daily liquidity. So we want to identify with the client what your moderate levels of protection are for cash.
Tax equivalent yield, this is kind of the tax-free bond. So if you're making 4 and giving up 2 in taxes, you got 2. It's not what you make, it's what you keep. And I think what we're talking about here is if you can get 4% on a municipal bond, that's going in your pocket. That's better than a taxable yield of the same amount, right? And so you really do have to pay attention to taxes. So
yep, we illustrated these at a 45% rate. And I can tell you, I have not had an environment for probably several years that we've been able to buy municipal bonds that are paying as good of a coupon as they are right now. We finally have a good interest rate market. Municipal bonds are a great place to be. And we typically, work with the client to figure out how long they can hold that bond. We typically are looking to get a level of call protection, meaning that municipality can't call that bond away from you. So if they're going to pay you 5% today, and let's just say that a year from now, they could refinance it and pay you 4%, we're going to lock in some level of call protection that might be 3, 4, 5 years, depending on what your needs are. And we can guarantee that, or not guarantee, scratch that, it's probably a bad word to use, but we can basically say with an investment grade insured municipal bond, they're going to pay that 5% for at least a period of 5 years without the ability to pull that bond away from you if interest rates go down.
Yeah, and I will say there's a big rookie mistake that I see people make from time to time, not too often, buying a tax-free municipal bond in your IRA. Rookie mistake, right? You want to have those, all things being equal, outside of your IRA, right? Because you're not paying income tax on that return anyway in your IRA, and anything that comes out of your IRA, you have to pay tax on. So you're better off, just big picture thinking here, keep your municipal bonds in kind of outside of your IRA bucket and your 401k bucket, and have other types of assets in that. Just kind of a basic
And again, municipal bonds, what we're talking about typically is, again, water districts, utility
Yeah.
districts, school districts, hospitals, toll roads, airports, things that are going to be investment grade again. And there is insurance agencies that not every municipal bond is insured, and not all municipal bonds are created equal, but the typical bonds that we're putting our clients in are typically going to be of that quality. What there is out there these days is different types of annuities, and an annuity is the only other type of product that is guaranteed depending on what they're stating the guarantee is. It could be a fixed annuity that guarantees 4% interest rate. It could be a participating annuity. What we're talking about here is a dual directional or a buffered annuity. There are different types of annuities. All of these types have different term commitments. They have principal protection on some of them, and some of them are buffered. What I mean by buffered is you could choose to be participating in the S&P 500 index with a 10% buffer. So you could choose to have a 10%, a 15%, a 20%, depending on what your tummy factor is on risk. And if the market is, if you're in a 10% buffer, let's just use this example here, the 20% buffer, if the market is down 23% in this example, and you have a 20% buffer, you're only down 3%. That's if you're doing a pure buffer. Now, there's typically a participation rate in the market where if the market is up, you're participating in 75% of the upside. So you have like a cap, this performance cap. So if the market's up 80%, you're only getting the 75. And then there are such things as dual directional. And you have one where the market is down 17. They're going to say, as long as it didn't go below that buffer, you're going to get a positive 17%. You know, if you invest on January 1st of 2023, January 1st of 2024, the market's down 17, they're going to credit you a positive 17. These different annuities exist. As you can see here, this is a 6-year commitment on this particular example. So some of these are 6-year commitments. There are other ones that don't have as high of a participation if it's a shorter commitment. This is just an example where if you've got someone that's just absolutely terrified of market risk and you want to transfer some of that risk to the insurance company, these products do exist.
Yeah. And, you know, this kind of reminds me of like betting on a football game in Vegas. There's a little bit of, not to say that it's gambling, but it's kind of hard to figure out, right? This is why you need an expert. This is why you need, Christine is a certified financial planner. You need somebody who really understands this and really has training on it. This is really not a DIY project. This can be very intimidating to people if you're trying to do this on your own. But reach out to Christine and we'll give you some information on how to do that. Mm-hmm. And then let's talk about the target outcome ETFs. What is, I love these names. It's like, who comes up with this? Is it a marketing department? What?
These have become wildly popular over the last few years. And it really does give people some sort of a level of protection. Again, an ETF is liquid daily. It's priced like a stock. You can get in and out of it. So it doesn't have an illiquidity period of time like an annuity. So there are buffered annuities, there are buffered ETFs, and there are various levels of protection where you could say, I'm comfortable with a 10% level of protection. If the market's down 10, you're down 0. And they typically have an upside cap where you can see here, this is a performance cap of 20% in this example. So if the market's up 21, you get 20. If the market's up 30, you get 20. If the market's up 5, you get 5. If the market's down 10, your loss is down 0. So these are buffers, as you can see in these different scenarios, that just says that the first downside risk is on the house.
Yeah, and it's all this is risk allocation. These are pooled. These are these are big, big gobs of money that these institutions put together, and you're able to spread that risk out.
Yep. So there are different areas to invest when you're nervous about volatility in the market. So not all of these are cash alternatives, as we wanted to talk about. There are cash alternatives. There is active cash management. These are other ways to invest in a volatile market. And so other alternative sources of yield would be private equity and private credit. These are typically limited to, accredited investors. So again, it just comes down to understanding what the client needs are. But it's important to understand that only 9% of companies out there are publicly traded. Most companies are private, and there are ways to invest in the private market space. It does come with additional illiquidity, so it is important to understand that.
Well, let's do this. Do you want to talk about this institutional? This is an interesting slide, and getting ready for this. This is really fascinating. So what happens? What do you mean by institutional real estate, by the way? What does that mean?
Not buying rental homes, not buying single family operating homes, not buying one individual apartment complex.
Yeah.
And we're talking like multiple multifamily units, storage, self-storage, huge shopping centers, huge office towers in, Chicago, New York, hotels, large portfolios of commercial real estate.
And these tend to go up when there's a rise in the treasury rate, right?
Correct. Yeah.
Interesting correlation.
Yeah.
Private markets we covered.
Yep.
Here's our content. Here's what I want to do. If you're watching this on YouTube, because this is going to be up on YouTube, if you're watching this on YouTube, when you call our office, and we'll get to questions and we'll handle those. Those aren't going to be on the YouTube, but we'll get to your questions here in a minute. When you call Christina's office, someone will answer the phone and they can connect you. Is that how it works? So if you're looking at this, you're like, oh my gosh, I'm totally confused. I need help. Reach out to Ascent Wealth Management. Reach out to Christina. She's got a great team. She's got Alyssa, she's got Shannon, and a bunch of, it's really girl power. I go into the office and it's a bunch of, literally it's all women. So
we are an office of all certified financial planners.
Yes.
And I do have my two partners, Shannon and Alyssa, that work with me. So sometimes people go, gosh, I want to meet with Christina. Well, they're also partners in the firm, and we all actually work as a team. So if you call our office, we're all equipped to work as a team to meet with you and just decipher what your needs are.
And when you call lawyers, don't expect to talk to a lawyer right away. But if you do call us and you say, hey, Jim, I need help with my estate stuff, or I want to, whatever it might be, my living trust and all those other things that are related to estate planning, let us know you want to update your estate plan, or certainly if someone's passed away or you're helping somebody else, let us know that and tell us your estate planning goals on that first call. Don't ask for pricing and don't ask for legal advice. Only lawyers can do those things. And the goal of the call is to coordinate a time where you can speak with a lawyer. So really that's the point of the call. If you're watching this on YouTube, please subscribe to our YouTube channel. And if you enjoy our webinars, hey, Google my business. If you punch Cunningham Legal into your Google search bar, we pop up. Write us a favorable review. We'd really help that. We'd really appreciate that. Next, if you're watching this, actually this video you might have already watched, which is the way YouTube is done. It's really weird. It kind of goes back in time, reverse, whatever. Estate planning basics: avoiding probate, saving taxes, and protecting your legacy. We're going to take it all the way back to the basics. And even if you've done estate planning, even if you, maybe if you haven't, whatever it is, you look at your binder and you go, wow, that's a lot of paper. I need to know the basics. I need to go back to the basics. So we're going to be covering that. And there's a link in the chat, and there's also a link in the description here on YouTube. And this is how you contact us. So what we're going to do, if you're watching this on YouTube, just keep watching, because the next webinar is going to pop up. And what we'll do is now we'll answer some of these questions here. So